Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young, and welcome back to What We Learned in the Markets This Week. Now, Friday was a fun day for the markets. There was a late surge that propelled the S&P 500 from about a negative 1%. I think it topped out about at 0.8 negative on the day, and then nearly returned the exact opposite, sprinting up to about a 1% finish to the positive side, enabling all three major stock indexes to close May on a positive note, despite recent declines in tech stocks. On Friday, stocks opened higher to start the day, and that was because the Federal Reserve's preferred inflation measure came out pretty positive before the market opened. The Personal Consumption Expenditures Index, PCE for short, that matched Wall Street's expectations, showing a 2.7% increase in April compared to the previous year. And we're going to learn more about that in point number 2. However, what started to happen later in the morning and into the afternoon is trader enthusiasm waned after the Chicago Business Barometer, which is a key economic activity indicator, dropped further into contraction territory, meaning the bad territory, and it hit its lowest point in 4 years. But then, like 15 minutes before the market closed, you saw all this buying activity intensify, and it drove almost every sector in the S&P 500 into positive territory for the month, except for energy. And you've been seeing a lot of consolidation in energy these last few weeks, the latest being Marathon Oil this week. Treasury yields fell on Friday, with the yield on the benchmark 10-year Treasury note ending at 4.512%, down from 4.55 on Thursday, and below the year-to-date high of 4.706 that we reached in late April. And on Friday, the S&P 500's largest gains came from energy, real estate, and utility sectors. Now, those are more defensive sectors. Technology shares, for example, were the only group to close the day slightly down despite the late rally. They were down 0.01. All this to say that this is how quickly it can change. Friday was the example of that. It was 2 p.m. on Wall Street and the markets were not looking good. And then it's 4 p.m. and they're looking great. It's why if you have an anxious or nervous personality, you need to read John MacArthur's book titled Anxious for Nothing. And you should definitely not watch the stock market or your investment or retirement account very often, because it's going to further exacerbate those anxious fears you have. In the long run, the market should do fine. In the short run, it can do anything. Since this was the last trading day of May, let's quickly analyze how the quarter is shaping up. With a bad month in April and now a good month in the month of May, the S&P 500, which is our proxy for growth and growth in income, but only when taken together, that ended the quarter up 0.87. Again, quarter meaning April and May so far. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, that is actually negative for April and May at a negative 1.22%. And the MSCI EFA, which tracks stocks across developed markets around the world, excluding the US, that for April and May was positive 2.09%, leading the pack for this quarter. Now, let's dive into our weekly roundup of economic and market data we look at each and every week. That starts with the Atlanta Fed's GDP Now model. And we love this model because it gives us a quick gauge into how our economy is doing in real time. Are we growing or are we contracting? Are we going the wrong way? This week, after releases from the U.S. Census Bureau and the U.S. Bureau of Economic Analysis, which saw a large drop in net exports, and that's going to hurt our GDP number when we're exporting less. It now has our quarterly growth at 2.7. Now, that's a good number, but as you can see, it's off the highs of the quarter, and those highs were around 3.6. We're down about 1% from the highs that the GDP Now model thought. Next, each week we review the 15 and 30-year mortgage rates to see if consumers are going to start seeing home affordability improve, which should improve the economy further. And that would be because of lower interest rates on mortgages. Well, this week we saw those rates tick back up. The 30-year version came back above 7. It closed at 7.03%, while the 15-year mortgage rate is coming in at 6.36%. Next, we like to gauge the front end, or the problematic front end, of the labor market, which is the initial claims for unemployment insurance, those going on unemployment for the first time. And they hit 219,000 this week, which is still well within a very good range for the labor market. As a proxy to give you a gauge on how good that is, if you go back to the week of May 30th of 2015, this was before President Trump was in office, that number was coming in around 275,000 each week. So we're 219, quite a bit lower. And finally, earlier we saw how the markets did for the quarter to date, April through the end of May 31st, end of May. But now let's check the markets for the week. And this week we saw the S&P 500, which is our proxy for growth and growth in income, but only when considered together. That was negative 0.51%. And next we look at the Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular. That was positive to the plus side, 0.16%. And finally, the MSCI EAFE, which tracks stocks across developed countries around the world, excluding the US, that was also positive, 0.16%. A nice tie. I don't know we see that very often for aggressive growth in international. And now on to point number 2. May 28th, 2024 was a date that was circled by many economists and those on Wall Street. Why? Well, because the Fed's favorite inflation gauge, which inflation is the story that keeps getting told, was going to be reported on this day. The PCE price index, a key measure of inflation, it increased by 0.3% in April 2024, according to the Bureau of Economic Analysis. And this indicates a slight cooling in the pace of price increases compared to the previous month. Excluding the often volatile food and energy categories, the core PCE, that index rose by a more modest 0.2%, representing the smallest gain of the year. Remember, PCE is better because it only tracks things we buy. CPI, a lot more broad. Consumer spending, a critical driver of economic activity, unexpectedly declined in April 2024. After adjusting for inflation, real personal consumption expenditures fell by 0.1%. This decline was driven by a decrease in spending on goods, particularly in categories like gasoline, vehicles, and recreational items, while spending on services actually showed a marginal increase. So goods down, services up. Several factors contributed to the trends observed in the April 2024 PCE data, and those were this. There's moderating inflation. The smaller increases in both the headline and the core PCE price indexes suggest some easing in inflationary pressures, potentially reflecting the impact of the previous interest rate hikes that the Federal Reserve has incorporated, 0 to 5% that we've gone. Also, in this report, we've seen shifting spending patterns. The decrease in goods spending, coupled with a modest rise in services expenditures, highlights a potential shift in consumer behavior. Factors like higher interest rates and pent-up demand might be influencing these changes we're seeing. And how about the impact on monetary policy? Are rates going to change because of this data? The April PCE data likely provides some reassurance to the Federal Reserve in its fight against inflation. The moderation in price increases could support the case for just doing what they're doing, which is pause, no interest rate hikes, no decreases, although the Fed, of course, is going to continue to monitor economic data very closely. The April 2024 PCE data offers valuable insights into the evolving dynamics of inflation and consumer spending in the U.S. economy. While inflationary pressures appear to be easing, thank the Lord for that, the unexpected dip in consumer spending does point to the question of, are there some uncertainties in the economy if we're just starting to spend a little bit less? How about point number 3? The S&P CoreLogic Case-Shiller U.S. National Home Price NSA Index reached an all-new high in March of 2024, rising 6.5% year over year. This report was released on May 28th for March data, an important lagging indicator for the market. Which, by the way, if you're interested in learning more about leading, lagging, or current indicators, you should come over to whitakerwealth.com and search market indicators. You'll see a ton of great content there written by Sumit Puri, our investment market research analyst. He did a great series on all the things to look at in terms of leading, lagging. Now back to the Case-Shiller Home Price Index. Rising by 6.5%, this sustained price growth occurring amidst high mortgage rates and very tight inventory, not a lot of properties out there, reflects a highly competitive housing market. Several factors contribute to this trend, and those are this. There's limited housing supply. We know that, okay? The persistent shortage of homes for sale is a primary driver of why prices are going up. Many homeowners are reluctant to relinquish their low 2, 3%, 4% mortgage rates, so they're staying put, further constricting inventory. Also, in regards to inventory, our internal and external research has shown that U.S. housing starts, which are building starts of single-family homes, they've increased by 5.6% in April, with housing starts of 5 units or more increasing by 31.4%. That might help inventory. How about demand? Is it soft or strong? Well, despite higher mortgage rates, demand for housing remains robust, fueled by factors such as population growth and a strong labor market, as we've been talking about. This demand, coupled with limited supply, creates upward pressure on pricing. And then, of course, there's all these regional variations. Our real estate company loves the Sun Belt. While all 20 major metro areas tracked by the Case-Shiller Index experience year-over-year price gains, regional variations are, of course, always going to probably persist. San Diego led with a 11.1% increase, while Denver and Portland saw more modest gains at 2.1 and 2.2 respectively. The Northeast, surpassing the Sun Belt, emerged as a top-performing region with a 8.3% annual gain. And how about another factor being mortgage rates? The Federal Reserve's effort to combat inflation through interest rate hikes have significantly impacted mortgage rates. We were at 2 to 3, now we're at, as we just learned, 7%. While rates have retreated from their peak of 8 in late 2023, they remain elevated, and that is creating higher borrowing costs, and that poses huge affordability challenges to potential homebuyers, further intensifying competition for available properties. So there's your update on the real estate market from that report we got this week. And finally, point number 4, starting May 28th of 2024, the U.S. stock market transitioned to a T+1 settlement cycle. Now, what does that mean? Investment trades will settle in 1 day after the transaction date. This marks a significant shift from the previous T+2 system and is the most significant change to settlement procedures in decades. Now, why did this happen? Well, there were several factors that drove the change, with a primary goal of reducing risk in the financial system. The transition is expected to minimize the risk of defaults by shortening the settlement window, ultimately lowering margin requirements for brokers. That's when you buy a stock, but you don't have the money to buy the stock, and thus you're borrowing it. Additionally, the move addresses concerns that arose during the meme stock frenzy of 2021, where brokers faced significant collateral demands due to the rapid price fluctuations of certain stocks. GameStop. While the move offers potential benefits, it also presents some challenges, such as international investors are going to be the ones particularly hit. The shortened settlement cycle may create difficulties for overseas investors who need to acquire U.S. dollars, trading in their own currency, but need to acquire U.S. dollars to complete their trades, potentially impacting market liquidity, especially during certain hours of the market being open. The change also necessitates significant operational adjustments for financial institutions. In our case, Schwab, they had to do a lot of work requiring modifications to their trading infrastructure, their workflows, and even their staffing arrangements to accommodate the faster pace of transactions. Suffice to say, nobody at Schwab in the trading department was on vacation this week. Despite these challenges, the shift to T+1 represents a modernization in the U.S. stock market infrastructure. While the transition period may present some initial hurdles, the move aligns the U.S. stock market with global trends and paves the way for further advancements in settlement efficiency and risk reduction. So thanks so much for watching this week's video. If this week's video was helpful to you, would you do us a favor? You can do us a favor by hitting the like and the subscribe button. That helps YouTube, Google, and Rumble's algorithms push our content out to more people. And when you hit the subscribe button, it allows our content to be released to you as we release it to the open market system. As well as if you would like to schedule a meeting with any of our financial coaches who help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, and live debt free, or our financial planners and advisors who help you in baby steps 4, 5, 6, and 7, build that retirement plan, work through college savings for your kids, and structure a plan to pay off your house, they would be more than happy to do that. You just got to go to the comment section and schedule a meeting with any of the great people on the Whitaker-Myers team. Thanks so much for watching this week's video. We'll look forward to seeing you next week.